Okay, guys, I told you, and I'm going to keep on telling you that this government, the United States government, your state more than likely, they don't have your best economic interest at heart. They're always coming up with a scheme that is basically, yes, I said scheme, that is basically targeted on raising the amount of money that they get from you in taxes. Latest scheme, latest bright idea from these guys is a tax on unrealized capital gains. Now, right now, you pay a tax on capital gains if you realize the gain. And by realize, that means you actually take possession of the money. Quick example. So you buy a stock for $50, and then the stock goes up to $100. So you bought it when it was $50 per share, goes up to $100 per share. Now you have seen a gain of $50. All right? That gain is unrealized if you don't cash out. If you just hold the stock and maybe you want to do a long-term thing, take some dividends out of it and hold it for a long time, it's an unrealized gain. You haven't taken possession of the money. You can't spend it. Well, what Janet Yellen, Secretary of the Treasury, has suggested, and others, there's a senator also that's talking about this, they want to tax you on your unrealized capital gains. So that $50 you made, you didn't cash it out, you're still going to pay taxes on that. Now, they're going to couch this and say, well, this is for the rich. The rich are going to have to deal with this. This is going to help the poor. Not hardly. What program that the government has instituted, what program have they ever instituted that really helped the poor? I'm from West Baltimore, okay? I haven't seen any. I have seen plenty of programs that enable the perpetuation of poverty, but not the elimination of it. So they're talking about doing that. I don't think they're going to do it, but who knows? Okay, they're thinking about it, which represents a threat to your pocketbook. And if it's only going to affect the uber wealthy, then how does it have an impact on us? We should be happy about this, right? They're sticking it to the rich. Well, whenever you hear rhetoric that talks about we're going to stick it to the wealthy guys, the 1%, we're going after them. Look, let's just be adults about it. I've never been given a job by a poor person, all right? Wealth creates opportunity. If you work for a company right now, I'm sure that company is actually making money in order to be able to pay your salary. So you know what? My whole makeup is not such that I'm jealous when other people are making money. I have no problem with Jeff Bezos's wealth, okay? I have no problem with a guy who, let's say he's on an NFL team and they're paying him millions of dollars to play that game. Hey, if you can find somebody who's going to pay you to do something that you know how to do, make the money, all right? But that's another example. You're not going to have NFL teams. You're not going to have entertainment venues. You're not going to have fine foods, vacation spots. None of that exists unless people are out there making money to provide that. So when these media figures try to get you all hyped up over hating the rich and disliking the wealthy, that's basically contrary to your interest. If someone's able to go out there and make $1, Jeff Bezos, let's use him as an example again. How can you complain about his wealth on the one hand and then anxiously run to your front door when Amazon rings your bell with another package and the convenience that that company has brought to the world? So the unrealized capital gains tax, that proposal is yet another threat to your pocketbook because it will cause investment to look elsewhere. Money goes where it's treated best. So if money is being taken out of the country and taken to places like India, for example, There are opportunities, even though the political relationship with China is in flux. There are opportunities in China, other places in Asia, other places in Europe. Money is going to go where it's treated best. And if you place an unrealized capital gains tax on the wealthy here, that's going to result in money moving out of equities, stocks in this country and looking for opportunities elsewhere. And that's going to hurt who? The middle class, because that's going to hurt 401ks. That's going to hurt job prospects as well. At the end of the day, we are dealing with, right now, $30 trillion in debt. We have the $1.9 trillion stimulus that has passed the legislature. We got $30 trillion in debt, and I keep on stressing to you, and you keep seeing it happen. The government is going to get that money. $223,000 per taxpayer is what we owe. Now, they're telegraphing to you, we, the government, are looking at all options to not really pay down the debt, but to wring more money out of the American citizens so that they can spend more. This country is not about solving the debt problem. I should say this government is not about solving our obvious and growing debt problem. But they're going to get that money from you. And for now, they're talking about, oh, the rich. They're playing this game where they're, America today, for some reason, is all about division. So they're going to divide to the extent that they can the middle class from the rich, even though both rely on the other in order to, survive. They're going to play this game where they divide and try to conquer and get you to believe that it's only the rich. But then you're going to find that over time, because we're racking up so much debt, that definition of rich is going to come down, and eventually it's going to hit your level. It's going to hit your level when you go to cash out that 401k at 59 and a half or older. When you do that, taxes are likely to be much higher than they are right now. In fact, there's an automatic tax increase scheduled for January 1st, 2026. All right, no matter what the current president does. So taxes are going to be higher, and it's going to affect you. It's not just going to be the rich. And taxes, basically, along with inflation, have the effect of taking money out of your pocket, taxes, and inflation makes the dollars that remain in your pocket less valuable. So how do you avoid this? Well, you got to look for ways to legally mitigate your tax burden. And one way to do that is with a properly structured cash value life insurance policy. Another way to do it is with a health savings account. If you have a high deductible health insurance plan, you can use a health savings account. Maybe talk to your employer about that option. See if they offer health savings accounts, because health savings accounts offer 3 very important tax protections, just like the properly structured cash value life insurance policies. You can realize tax-free growth. You can access that money if you do it right, if you do it in the proper way that the IRS has prescribed. You can access the money tax-free. And with regard to distribution, that can also be tax-free, again, if you do it correctly. So look for these opportunities to legally mitigate your tax obligation. We all got to pay some taxes, okay? Somebody tells you don't have to pay taxes, run in the other direction. But we can, there are things within the code that allow you to mitigate that tax burden. Now, if you're a business owner, you've got more opportunities than a W-2 employee. But if you're a W-2 employee, you still have opportunities that you can employ to mitigate that burden. So we're going to continue to watch all of these tax proposals that these guys are coming out with. A couple of things in closing. We've got on the table right now proposals for a tax on unrealized capital gains, money you have not seen. We've got dividend tax increase. We've got capital gains tax increase. On top of this proposal, to tax unrealized gains, they want to also increase the rate at which you pay capital gains taxes. And we've got the automatic income tax increase at the federal level coming up as soon, right now, as late as January 1st, 2026. So those are just a few, and those are at the federal level. I don't know about your state. I do know Hawaii has a proposal in to raise their top income tax rate to 16%. So can you imagine? Do the math. You live in Hawaii, you're at the top income tax rate, 16%. Top income tax rate does not mean you're rich. 16% plus, let's give you the 24% current tax bracket. So you add those up, and that's how much you're paying in income taxes, not counting sales taxes, not counting gasoline taxes, not counting your property taxes. So when you add up what you are ultimately being charged in taxes, it will make the argument clear that you need to try to keep as much of that money as you legally can. And we'll continue to monitor these taxes. We've got suggestions out on the table of what you need to look into in order to mitigate HSAs, also help you mitigate your medical costs, and properly structured cash value life insurance policies. I will talk to you soon.